Hi friends, welcome to our study classes. So in this video we are going to continue our discussion on the past 5 MCQ series which we have started for UGC Net Commerce Examination. So as a part of this series we are regularly discussing 5 important MCQs which have been asked in the past year papers and which have a very high probability of being repeated in the future also. So that's why we are covering all these questions in a very holistic and comprehensive manner. The topic for today is going to be accounts and finance. Now before proceeding to our discussion, let me quickly tell you about the courses which the Ever Study Classes is running for UGC Net Commerce. Now we are running both free as well as paid courses for UGC Net Commerce, and in the free courses we have a free mock test which is a computer based test on the latest pattern and on the latest mode which is going to be employed in the UGC Net NTA examination. So you can appear for this computer based test and get a feel of what it is going to be like when you appear in the final examination. Also, we are having a past year analysis discussion section in which we are regularly discussing past year questions, and this particular video is also part of that series, and all the PDFs of this series are available in this course of ours. And also we are running unit wise glossary, and in this particular series we have a unit wise glossary in which we have picked up important terms from each of the units, and we have written them in a very simple manner with proper examples and proper diagrammatic presentations so that you can grasp these terms in a very comprehensive and a very easy manner. Now apart from our free courses, we are also running these paid courses on test series for UGC Net Commerce. Now we believe that a practice makes the man perfect. So we believe that you should practice as many questions as possible, and these questions should be based on the UGC pattern and they should be based on the same mode in which you are going to appear in the final examination. So for this particular purpose we have provided you a computer based test series, and we have two set of test series. One is a full length mocks test series in which we are having 6 full length mocks for rupees 499. So these test series will have 600 questions and they are going to be based on the latest UGC Net pattern, and you are also going to get detailed solutions with explanations, and in case of any query you will always have the faculty support with you. And in the other course we are having a complete test series in which we are offering 12 unit wise tests of 100 questions each and a 6 full length mock test also containing 100 questions each. So you will have a total of 1800 questions in this test series, and they will also be on the same lines. It will be a computer based test. You will get the detailed solutions and faculty support, and this one is priced at rupees 999. So friends, let's start with the first question. The main effect of inflation on the financial statements is, options are profits are understated, overstatement of assets, adequacy of funds for replacement of assets, or erosion of capital. So friends, in order to answer this question, we must be aware about the concept of inflation and its impact on the financial statements. Now inflation is a sustained increase in the general price level of goods and services in an economy over a period of time. So if we are talking about the price situation in an economy, we are talking about the general price level of different goods as well as services, and if this general level has witnessed an increase, then this is referred to as inflation. Now this inflation has an overwhelming impact on the different things, and the financial statements, they are also impacted by inflation. And the effect of inflation on these financial statements can be seen through the following points. So first is unrealistic, imaginary and inflated book profits. So why this happens? This happens because of rise in prices. It results in overvaluation of stock in trade. So if we are valuing our stock in trade on current prices, this is going to overvalue it. And if we are writing off depreciation on the fixed assets as the historical rates at the older book values at their cost, so these are definitely going to be low, and the depreciation is going to be charged at a lower rate. So this is going to give us a feeling that our book profits, they are higher, but they are not higher in real sense. They are just inflated book profits. They are unrealistic, imaginary and inflated book profits. Further, payment of dividend and taxes. So out of this inflated book profits, we are going to make the payments of dividends and we are going to make the payments of taxes, as because this is from not the actual profits, but it is from the inflated profits. So this is much more than what we should have paid. So this is going to erode our equity capital. So all these payments, they are going to be from the capital, and the equity capital is going to be eroded, and that's why this is said that it results in erosion of capital. Further, assets, they are shown at cost of acquisition less depreciation, and the current value of these particular assets, they will be higher now because of inflation. So this again is not accounted for, and this is an effect of inflation on the financial statements. Further, due to ignorance of inflation, depreciation, it remains uncharged, as we have already seen in the first point also. So an indirect consequence of this is that sufficient funds, they are not set aside for replacing the fixed assets in the form of depreciation. So friends, this was about the impact of inflation on the financial statements. So now we can easily answer this question, that the main effect of inflation on the financial statements is erosion of capital. So we have seen that profits, they are overstated, the assets, they are understated because they are being stated at older book values, older cost, and there is inadequacy of funds for replacement of assets. So the only effect that remains is the erosion of capital, which stands true in case of inflation. Next question. Present value of future earnings is a model of human resources accounting suggested by. Options are Brosh Lev and ABA Squats, Jaggi and Lau, SK Chakraborty, Eric Flemals. So friends, if you talk about the popular models of human resource accounting, then there are two very popular models. First is cost-based model, and the second one is value-based model. Now the cost-based model, they are basically going to look at the different costs associated with the human resources, and the value-based models, they are going to look at the value which an human resource it creates for an organization. So first, let's take a look at the cost-based model, and there are three popular models of such a kind. First is capitalization of historical costs model. Now this is very simple. In this particular model, we are going to capitalize all the costs which are related to human resources. So expenses or the cost related to recruitment, acquisition, and training of human resources, this is going to be capitalized in the financial statements. Next is a replacement cost model. Now according to this particular model, the cost that would be incurred to replace existing human resources by an identical set of human resources is the value for human resources. So according to this particular model, the replacement cost, the cost by which we can replace our existing employees with a new set of employees, is the human resource accounting value. Another is opportunity cost model. Now according to this particular model, value of an employee in its alternative best use or in another division is used for estimating the value of human resources. So these are the three basic types of models associated with human resource accounting on the cost side. Another is value-based models. Now there are two very popular value-based models. First is present value of the future earnings model. Now this one has been developed by Lev and Schwartz, and it involves value of human resources as a present value of estimated future earnings discounted by the rate of return. So whatever earnings we are going to get in the future through this human resources, we are going to discount them and find the value of human resources. Other is a reward valuation model, or the Flemals model. And according to this model, an individual's value to an organization is determined by the services he is expected to render as he grows in the organization. So again, according to this particular model, a human resource, it grows with the organization, and the value which it creates in this particular process is the valuation of the human resources. So friends, now we can easily answer this question, that the present value of the future earnings is a model of human resource accounting which has been suggested by Lev and Schwartz. So the answer is going to be option number A. Next question. The treasury manager uses the derivatives in the bond market as well as in the forex market. It is the assertion, and the reasoning is it helps in risk coverage. And there are different statements with regard to the truthfulness or the falsification of these statements. So friends, to answer this question, we must be aware about the concept of derivatives in financial management. So derivative is type of a financial contract, and its name is called derivative because it's deriving its value from an underlying asset. So if there is a contract which relates to buying or selling of shares in the future, so this is going to be a derivative contract whose value is going to be dependent on the underlying asset, which in this case is going to be stocks. And similarly, there can be different underlying assets like indices, rate of interest, currency, or even different commodities. Now, so the derivatives, they do not have any direct value. Their value is just dependent on the expected future price movements of their underlying asset. So simply speaking, the value of a derivative, it depends on the value of the underlying asset. The most popular examples of derivatives, they are forwards, futures, options, and swaps. So these are the very important sets of derivatives instruments. Now, if we talk about the derivatives as a tool of hedging, now, first of all, we must be aware about the meaning of hedging. Now, hedging is a form of insurance. Now, if we talk about in the present context, it refers to the practice of reducing or fully eliminating the risk associated with holding a volatile asset. Volatile asset means it is very high chance that its prices may decline or it may rise. So there is a risk associated with the prices of these volatile assets, and that's something which we have to hedge. So hedging can be done through derivative. Let's see how. So first, let's suppose there is a bakery and it's worried that the price of the wheat, it may rise in future. So bakery has to use wheat to make flour, to make biscuits. So if the price of the wheat, it rises in the future, this is going to negatively impact the bakery. And at the same time, there is a wheat farmer, and this farmer is worried that the price of the wheat, it may fall in future. So here the worry was about rise in the prices, and the farmer is worried about the fall in the prices of wheat in the future. So what happens is they enter into a forward contract, which is a kind of a derivative contract in which they agree to buy or sell wheat at a future date at a certain specified rate. So they already decide that, okay, I'll buy this much kgs of wheat at this particular time at this particular rate. So they have already decided all the aspects about the forward transaction, and this is a forward contract. So that's why this can be used as a tool for hedging. So the risk which you had of rise or fall in the price of the wheat is now hedged, is now insured by entering into a forward contract. So friends, now we can easily answer this question that the treasury manager, it is going to use the derivatives in the bond market as well as in the forex market. So this is very simple because the derivatives, they are having their underlyings as both bonds as well as forex. So that's why they can be employed in both the bond as well as the forex market. And the reason is also correct, that they help in risk coverage or in hedging. Next question. Bolt system in the Indian securities market is related to. Options are National Stock Exchange, Bombay Stock Exchange, Over the Counter Exchange of India, Multi Commodity Stock Exchange. So friends, if we learn about this particular system, then first of all, we must be aware about that the NSE, the National Stock Exchange, and BSE, Bombay Stock Exchange, they are offering fully computerized screen-based trading facilities to the investors. So the investors, they do not have to physically visit the exchange. They can just sit on their computer screens and they can do the trading. Now the online trading in securities is an online platform, and it gives you access to stock exchange. Now this particular access in the form of online trading is provided by a system known as BSE online trading, that is Bolt by BSE, and by the NSE it is being provided as NEAT, that is National Exchange for Automated Trading. So this is about the Bolt system in the context of securities market. So friends, now we can easily answer this question that the Bolt system in the Indian securities market is related to Bombay Stock Exchange. So answer will be option number B. Next question. Which of the following is not a money market instrument? Commercial paper, participatory certificates, warrants, or treasury bills? So friends, first of all, we must be aware about the basic difference between money market and capital market. So first of all, let's take a look at the participants in these markets. Now in capital market, the base of participants is very wide. Individual investors like you and me, as well as the institutional investors like banks, financial institutions, etc. they participate. But in case of money market, the participants, they are just RBI, commercial banks, financial institutions, mutual funds, and big corporate houses. So individual investors, they do not generally invest in money market. And if you talk about the instruments traded, then for the capital market, they include equity shares, preference shares, bonds, debentures, etc. And for the money market, the main instruments, they are the commercial paper, treasury bills, a certificate of deposit, etc. And if you look at the duration of the securities which are traded in these markets, then for capital market, the duration is generally less than 1 year, and we say that it's around medium to long term. And for the money market, the duration of securities is very low. So this is a short-term securities market with a tenure of less than 1 year. And if you talk about the expected return, it is usually higher on the investment in the capital market, because in the money market, the investments, they are generally risk-free investments with a lower rate of return. The capital market is more risky, and the money market, this money market is usually safe. This is a less risky due to short duration and the soundness of the different sets of issuing companies. Now let us also briefly take a look at the different instruments which have been mentioned in this particular question. So first is commercial paper. Now commercial paper is an unsecured short-term debt instrument which is issued by companies for meeting their short-term liabilities. Now their maturities, they usually are around 270 days or less than it. Next is participatory certificate. Now this participatory certificate or interbank participation certificate, or IBPC as we'll be calling it in short. Now this is yet another short-term money market instrument whereby the banks can raise money, or they can deploy their short-term surplus. Now in the case of this particular certificate, the borrowing bank, it passes or it sells on the loan and the credit that it has in its book for a temporary period to the lending bank. So this is just a participatory certificate in which the different banks, they sort of participate together in giving out of money. Now another is a treasury bill, which is again a short-term money market instrument issued by the government of India through RBI. Now this is a discounted instrument and it's issued at a discount to its face value. Next is warrants. Now warrants, they are generally used as capital market instruments for raising funds by the companies, and they are generally in the form of option which is issued by the company to the buyers, that they can have a right to purchase some shares of its equity share capital at a given exercise price during a stipulated period. So this is about warrants, that they are a kind of capital market instrument and they can be converted into the securities as per the conditions attached to it. So friends, now we can easily answer this question that the warrants out of these, they are not a money market instrument, rather they are a capital market instrument. So friends, this was all about our discussion on the past 5 MCQs with regard to UGC Net Commerce. Thank you friends. If you enjoyed watching this video, please like the same, subscribe to our YouTube channel and share it with your friends. If you have any query, you can drop a mail at hello@everstudy.in, or you can follow us at facebook.com/everstudyclasses. You can also join us on Telegram, and our Telegram channel's link is t.me/everstudy.